Morning, folks. Everything new under the sun. Well, today I want to take a look at a couple economic articles. The economy is not looking good, and there are some flashing red signs, red alerts. So prepare yourself accordingly. This is significant news. This is a chart from the St. Louis Fed, fred.stlouisfed.org, and it shows basically the interbank loans, not the interbank loans rate, which we would expect to go down if things get really bad, and it hasn't quite started going down yet. But this is in billions of dollars, the lending between banks, and the more they lend, the more comfortable they are, the more happy they are that they, and the more convinced they are that they're going to get their money back for the loans that they provide between banks. So you can see when this started in 1973, that's when they really switched completely over to fiat currency. It was low. I think it was about 10 or 20. Let me just move my mouse over that. In 1973, the value was $29.675, and that's $29 billion. And ever since, it's risen. Then we have the 2001 spike there, and it rises to $321 billion, and it goes long. And then we see the 2008 crash, and we see a big drop off from the top 2008 in about 460 billion, and it dropped right down. This is a credit freeze. It dropped right down to $313 billion interbank loans. This is where the money between banks froze up. They weren't lending to each other. And so they released a whole bunch of fiat currency, quantitative easing. They printed a bunch of money to get the banks lending to each other once again to stop the credit freeze. And then through that, even with all the quantitative easing, they were still lowering every week, every month, the amount of money that they would lend between each other, between the banks. And so we scooted along 2013, 2014, 2016. And then to look at the end of the chart here, now we have a massive drop-off even below what it was. Let me expand this out just to 2018, let me see, 2014, 2015. Here we have basically 2016. Let me go there, and we just have this section of, you can see at the bottom, 2016 to 2018. And where are we right now? So here is October 2017. It's been pretty level. The banks have been lending each other the same amount of money for a long time, about 60, 70, 80 billion. And then you come January, and this is updated weekly apparently. So December 27th was $68 billion. And then we come January 3rd. This is the last data point, and this is what people are talking about. You can see $13 billion on the bottom there. Remember, at the start of this, when this began in 1973, they started off lending $29 billion. So this is even lower than the lowest value it's ever been in the history of the interbank loans after the U.S. went full fiat currency, backed by nothing, effectively. And so you can see a massive drop-off. This is what people are concerned about, because this is a credit freeze. This is the definition of a credit freeze. This is what happened in 2008. If we go back to 2008 here, here is 2008. You can see a massive credit freeze. This is when banks stopped loaning, and this means they're not going to loan out any money to you either. And this is what happens. So when you see this at the end there, that means if that doesn't come up real quick, and we haven't got more news yet, I'm not sure why, because this is supposed to be, if you look at the top here, billions of US dollars, not seasonally adjusted, and the frequency, this is supposed to be weekly, and so the last updated information apparently is from February 2nd, but if this is weekly, why do we only have information to January 3rd, which is the last value there? We should have a couple of more weeks of data there. And why is that? Look at the value, 13.27, last observed January 3rd. So again, the question is, what are they doing? What are they keeping from us? Well, a couple of articles here. This is one from Zero Hedge, and it's a world's largest public hedge fund urges investors to resist the temptation to buy the dip. So there's a big dip on the stock markets. Of course, we had the big hit And this hedge fund company is basically telling people do not buy into the market again. They are suggesting there's bigger problems to come, echoing warnings from the world's largest hedge fund, Bridgewater. A bigger shakeout is coming. What does a bigger shakeout mean, and how do they know there's something larger coming? And Europe's largest asset manager on Monday let the dust settle, as well as a plethora of other industry experts with more skin in the game than usual. Commission taker that confirms this is a healthy correction. The CIO of Europe's largest publicly traded hedge fund is warning investors to resist the urge to buy the dip or chase the rip. So they think it's going to go down further. It goes on. The instinctive inclination to buy the dip may be strong. As the past week has shown, this may not work so well. Indeed, I think we have seen in the past week what we have seen in the past week could continue for some time, and they think there's going to be trouble in the markets for some time. So going over to another one here, this is DiMartino Booth. This is let's see, Daniel Martino Booth. Don't count on Powell Fed, so the newest Federal Reserve chair, to rescue these markets. So she, who is a former Federal Reserve insider, is saying that the Federal Reserve doesn't want to prop up the markets anymore, and the suggestions by Powell is that he isn't interested. So according to a recent report by the Pentagon, the Pentagon is considering plans to transfer him. No, what am I reading here? That's not what I'm reading. Let's see. I don't know where that came from. All right. The recent gut-wrenching drop in asset prices began on the first day of the job for the now Federal Reserve Chairman Jerome Powell. How is Mr. Powell likely to react to a suddenly sick-looking market? Will he step in forcefully to reassure investors that there's a Powell put in place as a backstop? Will the Federal Reserve come up with some money printing or do something to support the markets? To address these questions, former analyst, Federal Reserve Bank of Dallas, Danielle DiMartino Booth, returns to the podcast this week. In her opinion, having studied Powell's previous statements, she thinks those expecting him to continue market support his predecessors provided, Janet Yellen, will likely be quite disappointed. Powell appears to be no large fan of continued QE and has long been on the record as concerned about the eventual pain its unwind causes. So he knows the trouble it causes, and he knows the pain that the unwind is going to cause. And he very well may resist riding to the market's rescue this time. So he's going to let it down and going to let it, quote, air quotes, correct, possibly. And we kind of see that happening. Compare and contrast Jerome Powell's silence in the wake of the flash crash, his first day at work, to Alan Greenspan, who got on a plane the day after the black crash of 1987, canceling the appearance that he was to make, and reassuring markets with a statement on Tuesday morning that the Federal Reserve was standing by and ready and willing to and available to satisfy any kind of disruption. So Greenspan was willing to do anything it took to keep the markets propped up. But Jerome Powell hasn't done that. That was the day in October 20th, 1987. So Powell himself has stated that he was concerned that quantitative easing would end up being habit-forming, and yes, it absolutely has. So I read his silence these last few days as a prudent and cleaving to the original intention of the Federal Reserve being lender of last resort, not babysitter to the stock market. So there's a video there featured, related to the podcast where she says these things. You can check out the links. I'll try and put the links in the description. But a couple of articles suggesting that this is not the end of it. The Federal Reserve isn't interested this time in attempting to prop it up, which is good. The market needs to correct. But does this trigger a complete and total economic collapse? And then the more conspiratorial thinkers may wonder what Jerome Powell's position is in the Federal Reserve. Is he the fall guy? Is he put in place to help the markets collapse under Trump? Maybe he's a Democratic pawn, if you will. I'm just putting that out there because who knows what could happen, and who knows. That there's powers that control the Federal Reserve and the deep state, as they say. And if Powell is a pawn, maybe he's in there for a particular reason to do a particular thing, and maybe he wants to allow the markets to get dragged down and downwards. But significant regardless, that you see other investors saying, this is not the end of it. This is not the bottom. And I don't know. We're going to see what this interbank lending means when we get over the next couple of days, weeks, as we get some more data here and see, has it really completely froze up? Is this just a blip from January 3rd, you know, post-Christmas? Will this just pop back up to where it was? We don't know exactly what this means. But again, apparently this was updated Feb 12th. So are they hiding data from us? What's going on with this? I'll put the link to this as well so you can see this chart. And this is kind of the big news. What is happening with this? I saw a video. Who was it? Oh, I forget the speaker. Lynn something or other was talking about this. The name escapes me. Regardless, Lynette Yang. Lynette, what's her name? Let me see if I can find it here. Please stand by. Let's see. Please stand by. I think that's who it was. See if I can find the video that I was watching. Yes, Lynette Zhang. The banks are getting out first. That's what she's suggesting. They're freezing up credit. And this was from a video from Reluctant Preppers. The banks are getting out first. The search for the banks are getting out first. Where did all our money go? Lynette Zhang. She's basically looking at this chart and saying there's something happening here. The banks are starting to consolidate. They're starting to close up and freeze up money. They want to conserve the money that they have. They don't want to lend it out because they're scared of something coming. So again, what is coming? We don't know, but this is potentially a massive trigger point for the world economy. So pay attention, guys. Be prepared. This is, well, is this signaling something? I think it's a massive signal in terms of the chart that actually shows there. So what does it mean in the long run? We don't know, but stay tuned, guys. This could be a significant chart as we look over the next couple of days.